Hey guys, I'm the Newb investor. I've done some work on my metrics. I've added some vital data I wish I had used before. Anyway, this should be the start of that, and my metrics should continue to evolve from here. Today we'll try to make sense of PayPal's 60% drop from the highs. We'll be screening the stock by purely looking at their financials, none of their fundamentals, through my three metrics to see whether the stock is trading at overvalued, fair, or discount prices. And from there, we should see whether the stock is a buy or not. PayPal is currently trading at $110.94 with high price of $310.16. That's 64.23% of the highs. Market cap of $129.25 billion, PE ratio of 31.56, and EPS trailing 12 months of 3.52. They don't give out dividends. Looking at this chart, if you had bought the stock at $290 and above, you bought it at a PE of 71.09 with EPS of 4.1 at the time. That is a multiple of 14.34 times earnings. Now, I want you to remember that because we'll be matching that with their financials later on. First metric, we want an EPS lower than 3. We get the EPS multiple by dividing the current PE by the EPS trailing 12 months. Is that set in stone? That 3? No. It's just how I usually screen my stocks. This metric tells us how much we're paying for the stock based on their current earnings. It also tells us the relationship of their shares outstanding to their net income. Obviously, the lower the number of shares, the higher the EPS, the better. This metric asks the question of, is the company buying back enough shares to justify the market cap? So you can see here the EPS history. It's nice to know that it's growing and their shares outstanding over the years decreasing, which is good. Back to our metric, divide the current PE, which is 31.56, by the EPS trailing 12 months of 3.52, and we'd get our multiple of 8.97. This means that if we buy the stock at this price, we're buying it at 9 times their current earnings. Does it mean it's not a buy? No, but is it worth paying for? Let's proceed to our next metric. Second metric, we want to pay $1 or less for 1% of the money they're making. I took the values from Seeking Alpha and I cross-checked it with Yahoo Finance and Microtrends. There are some discrepancies with COGS and OE, which is fine. We don't need them that much. Anyway, the rest is the same. The values above are in billions. The values below are in percentages of their respective revenues of the years from 2017 to 2021. I'll show you the relationship of the sales. For example, this here, 53.01% is 13.45 divided by the revenue of 25.371. You can see the relationship here. Do that for all the metric and the components. There. Now, why do I do this? Because we want to know how much of the revenue was spent to what component. Now, we take the lowest value among the values of the current year's yields and the averages of 5 and 10 years. The more data, the better, but in this video, we'll only be using 5 years of data just to show you our process. Now, why the net income and the free cash flow, you say? Because that's what we're paying for in a stock. Not the costs, but the money they generate. Why take the lowest value? We want to take the lowest value because that would make the baseline of our assumptions. You'd see here the breakdown of the revenues, how much of the money was spent, and where the money goes, the costs and expenses, and the income. In average, they use 80% of the revenue as costs, 15 to 20% as income. The diluted net income here is after taxes. I've also included here the revenue growth over the years because the second metric does not account for the values of the revenue. It is vital that the company grows even 1% or just have the same revenue. Remember, the loss in revenue would still make the same yields but with lower values. That's why it's important that I add this here. This is year over year, and this is the 5-year growth here, not in compounded form. If you look closely, there is this drop in growth in 2021 by only 2%. Now, I don't know how much of the fundamentals has changed, but it hasn't been reflective in their financials. Does the 60% drop in market value justify the loss of 2% growth? Or because of weak guidance? I don't know, but I don't think so. What that was for me is that the stock just got very expensive to the point of having 17 times multiple of earnings. I think the drop was expected and there could be more downside. But back to the metric, we take the lowest value of the highlighted ones, which is 15.38. We'd use that to divide the current PE of 31.56 and we'd get a discount of 2.05. If you had bought it at $290 and above, you bought it at a high PE of 71.09, a discount of 4.62 times. Now, it's up to you guys what multiple you'd use to account for the revenue growth, because obviously the growth is there and it's strong, but buying it at 2.05 times, it is expensive as you'd be buying $1 for 2. Next metric, we want to know our discount compared to how the markets have valued the stock before. I'm using 2 historical data here, one from Guru Focus, where the data is readily available, and one from Macro Trends, where I took the PE manually from the range of consolidation the stock has traded before. You can see here the highs and the lows, but we'll take the lowest of the average historical PE because we want to base our assumptions at the lowest PE. In this case, it's 51.08. We'd use it to divide the current PE of 31.56 and we'd get a discount of 0.62. What this means is we're buying the stock at a discount now compared to how it was valued by the markets before. 0.62 times tells us that PayPal has been trading at high PEs even before. Looking back at the PEs it traded, I think it's valid to ask, why is it trading at high PE? Is it because of the multiple of revenue growth? Or is it because their profit margins are expected to increase like Visas and MasterCards at around, half their revenue? Or was it all hype? In conclusion, the stock beats one of my 3 metrics. I think the stock is still trading at overvalued price only because of the 2.05 times multiple. But if you're comfortable buying it at that multiple, have a go at it. Buy it now. I don't own the stock. I don't love or hate the stock. I look at this with my humble and honest opinion. No biases. Should you pay premium for this stock? Absolutely. You should. Its revenue is growing, 18% in average. But is it 2.05 times like it's trading now? I don't know. It's a preference. Choose your own multiple. Would I buy it? No. Not at 2.05 times. If I were to use a multiple, it will be 1.5 times. That would make my entry price of $95. Anyways, I think PayPal's fair value is around $75. That is when you multiply the current EPS of 3.52 by 21, which is the cash flow yield from my second metric as PE. Now guys, this is brutal, but I don't think the stock will see its high in a span of a year, or at least in a short term. I think there will be bag holders of the stock for a long time. But that's just me basing from the financials. Now, I'm looking at the charts and I'm slowly realizing that I may have missed the boat. I wish I had done this analysis sooner. These 3 metrics I use is designed to determine the best PE to buy a particular stock, as I believe PE is the price we pay for in a company. This is my process of screening stocks to buy at what PE by looking purely at the company's financials and none of their fundamentals. If you like to invest in these companies, I'd advise you to look at their fundamentals, their charts, and more of their financial data and metrics like long-term debt, some important financial ratio, etc. As always, do your own research.